So friends, now we have to discuss the flat rates. Now the next phase is all about the flat rates applicable for non-residents. What is flat rates? For certain types of income, non-resident have to pay the taxes at some respective rates. Under that, we can say the heading as special rate of tax applicable to certain income of non-residents, chapter 12. Special rate of taxes applicable to non-residents, which is as per chapter 12. That's what we are about to discuss right now. So under that, the first section that we are about to cover is section 115A. A small part of 115A that we have already discussed under 44DA. That too very small part. 115A is actually a humongous section where we have a lot of items to discuss under 115A. So we'll start our discussion one by one. The first one, tax on dividend and interest in the case of non-residents and foreign companies. For certain incomes, non-residents as well as foreign companies have to pay tax in accordance with this particular provision, and that's what we are about to learn one by one. So we will discuss 115A one by one. So rather than explaining it here, I'll make use of a chart. So I want all of you to take a note of this charts which I'm about to draw. Starting with the first item under section 115A, item number 1, what we can say is, listen, say you are a non-resident or a foreign company. You are a non-resident or a foreign company. You are in receipt of dividends. You are in receipt of what? Dividends. From Indian company. From Indian company. So you are invested in, you have invested in Indian company and you are receiving dividend from that Indian company. Basically you are a non-resident or a foreign company. Then what is the rate of tax? These dividends are taxed at 20% rate under section 115A. This is the first one. So if you are a non-resident or a foreign company receiving dividend from Indian company, it is not taxed as per the slab rate. These are taxed under 115A at what rate? 20% rate of tax. Are you with me? That point number 1 is pretty simple. For that, there is another additional explanation. What is that additional explanation? Listen, if you are, so point number 2 is very simple. If you are receiving dividend from any company, say Indian company, which is located in IFSC. This Indian company located in IFSC. What is IFSC? International Financial Service Centers. What is International Financial Service Center? International Financial Service Centers. What is International Financial Service Center? To get more foreign funds. To get more foreign funds, Government of India have recognized certain area as a special area, just like that, to promote exports. So government has recognized certain area as what? Special area, where this foreign investments companies can come and incorporate a unit in IFSC. If they incorporate a unit in IFSC, they will get a lot of tax benefits. A lot of legal formalities have been relaxed, so that it is easy for a foreign investor to come and incorporate in IFSC, and they can invest in Indian companies and they can invest in other businesses in India, and they can take out return and they can claim tax benefits as well, which is under section 80LA. We call it as 80LA deductions is there. Are you with me? So the point is, if you are a non-resident or a foreign company who has invested in this entity or invested in a company which is basically situated in where? Which is basically situated in IFSC. Which is basically situated in IFSC, that is International Financial Service Center. and you are getting dividend from this. You are getting what? Dividend from them. Then the rate of dividend is only 10%. The rate of tax, not rate of dividend, rate of tax for the dividend is only how much? 10%. Are you with me? So they are giving a kind of a discount. From a normal company, if you are getting a dividend, you have to pay tax at 20%. From companies which are situated in IFSC, you are getting a dividend. If you are a non-resident or a foreign company, pay us only 10%. Are you with me? So that there will be more investment in the companies which is in IFSC. That company which is in IFSC will get more funds, and they will be able to distribute that funds in India. Are you with me? Great. So right now the IFSC that we have is in Gujarat. It's Gift City, Gujarat International Financial Tech City it is. Now, moving on. Second one. So this is basically first one, and it is a sub point of first one. Basically both are what? Dividends. Okay, so I am not writing it as second point. I am considering it as only point number one. And point number two, these are not subsections or points. Okay, just putting some numbers. Are you with me? Don't take it as subsections or anything. I'm just putting some numbers. Point number two, what they are saying is, say you are a non-resident or a foreign company. You are either a non-resident or a foreign company, and what you have done, you have invested or you have given loan to government or Indian concern. You have given what? Foreign currency loan. Foreign currency loan. You are a non-resident or a foreign company. You have given what? Foreign currency loan to either to a government of India or to an Indian company. You have given foreign currency loan to these two entities. If you are given foreign currency loan, then you will get back what? Interest. This interest shall be taxed at what rate? 20% rate under section 115A. So if you are getting any interest from foreign currency loans that you have given to governments or Indian company, that entire interest will be subjected to what rate? 20% rate of tax. For a foreign company, it is very much beneficial. Their normal rate of tax is 35%. They only have to pay 20% as taxes. Now, point number three. Say you are a person, say non-resident or a foreign company. You are a non-resident or a foreign company, and you have invested in infrastructure debt fund. Infrastructure debt fund, which is in India. You have invested where, friends? In infrastructure debt funds. And who are you? You are basically a foreign company or a non-resident. If you are investing in infrastructure debt fund, from that fund you will get interest. This interest again taxed at 5% rate only under 115A. 5% under section 115A. So if you are investing in infra debt funds in India and you are getting some interest income from that, that is only subjected to what rate? Only 5% rate of tax. Are you with me? There is no investment date or nothing you have to follow. You are getting interest income from infrastructure debt fund, only 5% rate of tax. So people, if they think internationally, this infrastructure investment fund globally is taxed at a cheaper rate. So what people will come and invest in infrastructure debt fund, and we will get more funds to develop our basic infra, so that we can construct our basic infra. We can develop our basic infra. That is the very idea of giving a concessional rate of tax for these interests. Are you with me? Coming back to the point, friends, where were we? So if you are investing in infrastructure debt fund and you are getting some interest back, that interest is subjected to what rate? Only 5% rate of tax. Now, moving on to point number 4. Let's understand what is this point number 4 right now. Yeah, I'll draw point number 4 on the next page. Okay. Yeah. Point number 4. Again, say you are a non-resident or a foreign company. You are a non-resident or a foreign company and you have invested in, again, foreign currency. You have given, not invested, you have given foreign currency loan. You have given what? Foreign currency loan. You have given foreign currency loan either to an Indian company, or to business trust. Either to an Indian company or to a business trust, you have given what? Foreign currency loan. So this foreign currency loan, there is a speciality. There should be a loan agreement. There should be a loan agreement which is signed between 1st July 2012 and 30th June 2023. If the loan agreement is signed between these dates, maybe this year 24-25 or 25-26 or whatever it is, you are getting some interest from that. That interest is taxed at what rate? Only 5% rate of tax. So here 5% concessional rate is subjected to certain conditions. First of all, there should be a loan agreement. And the period of loan agreement is crucial. It should be between 1st July 2012 and 30th June 2023. If the loan agreement is before or after this period, then all the interests will be taxed according to the rate provided in point number 2 as a normal foreign currency loan at 20%. If the loan agreement is signed between these period only, the rate of tax will be at 5%. Are you with me? Are you with me? Yes. Moving on to the next point, friends. Let's understand what exactly is the other points. Listen. So, again, the hero is our same non-resident or foreign company because this is NR taxation and everybody will be either non-residents or foreign company. There is no change in hero. Non-resident or a foreign company, what they have done, they have invested in. They have invested in long-term bonds. Long-term bonds. They have invested in long-term bonds which is issued by either an Indian company or a business trust. Which is issued by either an Indian company or a business trust. So you are a non-resident or a foreign company. You have invested in long-term bonds, which is basically issued by a Indian company or a business trust in India. And this investment should be in foreign currency. This investment should be in what, friends? Foreign currency, and they should have an approval from central government. They should have an approval from central government for such investments. Plus, the investment is made between, or the investment should be made between 1st October 2014, not 2020, sorry, 2014 and 30th June 2023. That investment should be made between 1st October 2014 and 30th June 2023. If all these things are satisfied, foreign currency, approval from CG, investment date, if everything is satisfied, you will get what? Return interest income. This interest is also taxed at what rate? Only 5% under section 115A. Everything is 115A. Okay. So this interest is also taxed at 5% under section 115A. Why I am making you write all these charts is to give you an absolute clarity on what is what. Are you with me? Because in examination, they might test all these things. with very minute conditions are there. You have to be very much careful with the conditions and you should study all the conditions. To give you an absolute clarity on what is what, I'm making you write all the charts. When you revise, this will actually save your time. Are you with me? Now, moving on to the next one, item number 6. Item number 6, let's understand what exactly is that. Listen, say you are a non-resident or a foreign company. You are a non-resident or a foreign company and you have invested in rupee denominated bond. Rupee denominated bond. You have invested what? In rupee denominated bonds. So basically the purpose of rupee denominated bond is Indian companies can issue this rupee denominated bond and raise foreign funds. Okay. So you have invested in rupee denominated bond and this investment rupee denominated bond issued by Indian company or business trust. Indian company or business trust. BT means business trust. Now there is one more thing. This bond, this investment should be made before 30th June 2023. You have to make this investment on or before, that means the bond have to be issued on or before 30th June 2023. If it is so, then whatever interest that you are getting from this bond shall be again taxed at what rate? Only 5% rate of taxes. This also is subjected to what rate? 5% rate of taxes only. I hope that point is also clear for you. Now there are a few other things that you should know. Listen, see, we have discussed about interest from long-term bond as well as rupee denominated bond. Yes or no? Long-term bond was covered in point number 5 and rupee denominated bond was covered in point number 6. Are you with me? What was point number 5? If a non-resident or a foreign company invests in long-term bond issued by an Indian company or a business trust, investment should be in foreign currency, approval from government is required, investment should be made between 2014 and 2023. Then in point number 6, we have said that NR or a foreign company invest in rupee denominated bond issued by a Indian company or a business trust, investment should be made before 30th June 2023. There you are getting interest income. So in both these cases, the rate of tax is only how much? 5%. Are you with me? For that, there is another concession. For these two interests, there are certain other concessions. So we will write it as a note. If bonds, or rather I will say long-term bonds, or rupee denominated bonds covered in or covered under point number 5 and 6, 5 and point number 6 as above. They have certain specialities. If long-term bonds and rupee denominated bonds which are covered under point number 5 and point number 6 are listed on a recognized stock exchange. RC means recognized stock exchange, which is located in IFSC. If these two bonds are listed and traded through a recognized stock exchange which is listed in, which is through a recognized stock exchange which is located in International Financial Service Center, then department gives another concession. Let's understand what is the concession. Listen, if that investment is between, 1st April 2020 and 30th June 2023. That means you have invested in this long-term bond or rupee denominated bond, which is listed or which is listed on a RSC which is located in IFSC, and you have made that investment between 2020 and 2023. In such case, all the interest are taxed at only 4% rate of tax in the hands of NR or foreign company. Instead of 5%, it is 4%. Are you with me? Are you all here? In the case of interest income from these two bonds, if it is listed outside IFSC or if it is not listed, then the rate of interest, the tax for the interest is at normally 5%. But if it is listed in a recognized stock exchange which is located in an IFSC, we are giving you an additional 1% discount. You pay tax only at 4% instead of 5%. Are you with me? And let me ask you one simple doubt. What if in the above case, that means point number 5 and point number 6, what if I've made that investment after 2023? If the investment is after 2023, then bonds also are considered as kind of a debt. It will be taxed at 20%. That's it. Normal foreign currency loan, similar to normal foreign currency loan, it will be taxed at 20%. But here, what department say, we are planning to continue the benefit of what? Those bonds and rupee denominated bonds and long-term bonds which are listed in an RSC which is located in IFSC. In that case, even if the investment is made after this date, if the investment is after 30th June 2023, in this case also, we are planning to give you a concessional rate. And how much is the concessional rate? In such case, interest taxed at 9% in the hands of NR or foreign company. Instead of 20%, we are only saying pay tax at what percent? 9%. Are you all here? If on account of that investment you are still getting an interest, that interest will be subjected to 9% rate of tax right now. I hope it is clear. Are you with me? Out of which one they will test in exam, that we cannot predict. Are you all here? So it is better to study everything because 115A is an important section. It's better to study all the items under 115A. So I hope this much is clear for you. Now you have a happy news over here. You can simply strike off this thing. This is not required. This thing is actually not required because this is basically interest payable or interest receivable between 2020 and 2023. That period is already expired. Only for an information purpose, I have given this particular blue chart over there. This blue chart you wouldn't have to study because it is not investment basis. It is based on the payment date, and that is not active right now. The payment interest received from these between 2020 and 2023. Our relevant PY is anyways 24-25. So this is actually not applicable for us. Now, not yet over. Say you are a non-resident or a foreign company. You are either a non-resident or a foreign company. You have an agreement with either an Indian company or an Indian concern or government of India or central government. You have an agreement between Indian company or central government, and based on this agreement you are getting royalty or FTS. It is taxed at, you tell me, what is the rate of tax? Taxed at 20%. 115A. Hope you remember. Under 44DA, we have already covered this. If you are getting royalty or fees for technical services from an Indian company or directly from the government of India, based on an agreement, there is no PE, the agreement is either before 2003 or there is no permanent establishment or the services are not connected with the permanent establishment, etc. then the royalty and FTS will be taxed under 115A. At what rate? 20% rate. That's what this point is all about. Again, one more point is there. Say you are a non-resident or a foreign company. I forgot to put the numbers. So this is number 7. And now we are about to discuss item number 8. Say you are a non-resident or a foreign company, and what you have done, you have invested in mutual funds. You have invested in mutual funds, or you have invested in UTIs. You have invested in mutual funds or UTIs. That investment should be in foreign currency. That investment should be in what? Foreign currency, and you are getting some return from this. You are getting some income from this, which is taxed at 20% rate of tax. If you're getting some return from that mutual fund or UTI, then the rate of tax will be at what rate, friends? 20% rate of tax. That's what the department say, but the investment have to be in foreign currency. I hope all the 8 points are clear for you, and one more thing is there that we will cover in the chapter business trust chapter, but still let me simply read it. Income received by non-resident or a foreign company being unit holders in a business trust. Interest income distributed by business trust from SPV to unit holders, rate of tax 5%. Dividend income distributed by business trust from SPV, which has exercised 115 BAA, to unit holders, taxed at 10%. This green table you have to study, but we will cover this in which chapter? Business trust. Assessment of business trust, we will cover that particular green table. For the time being, you don't have to worry about that particular green chart. Why? Because you should know what is business trust. You should know what is special purpose vehicle. You should know what is distributed income concept, etc. That we will cover in BT, assessment of business trust. Are you all with me? Now, only 50% of 115A is over. We have conditions. Now here what, friends? Conditions. We have only covered the rates. Now we have conditions. Let's study conditions one by one. So under conditions, the first condition is pretty simple. No deduction. What is that? While computing income under 115A, an assessee cannot claim any deductions under section 28 to 44C, as well as a deduction under 57 is not allowed while computing the income covered under 115A. What is this 28 to 44C? Deductions under PGBP. What is this 57? Deductions under IFOS. Imagine you are a non-resident or a foreign company having interest income or a dividend income. This interest income and dividend income will be never taxed in salary head. This will never get taxed in house property. This will never get taxed in capital gain. So the only two possibilities are either PGBP or IFOS. If it is under PGBP, 28 to 44C, nothing you will get. If it is under IFOS, only deduction section is only one section, 57, nothing you will get. Or simply we can say, no deductions from the above income. No expenses can be deducted from the above income. It is fully taxable. Are you with me? Now, next one. No chapter 6A deduction. Deduction under chapter 6A is not available in computing interest and dividend income as above. Listen. You will not get chapter 6A deduction from interest income and dividend income. Then what about royalty income and FTS? You can. Chapter 6A deduction is allowed from royalty and FTS income. That is okay. From other incomes, you are not supposed to claim any chapter 6A deductions. Are you with me? Only from interest income and dividend income, you can claim chapter 6A deductions. From other income, you are not supposed to claim any chapter 6A deductions. Sorry, for interest income and dividend income, you cannot claim chapter 6A deduction. From other income, right, royalty and FTS, you can claim chapter 6A reduction. What is next? Return of income not required. Another greatest advantage given. What is that? If total income should consist only of dividend income, interest income, royalty income, FTS income as above, and TDS has been correctly deducted. If there is any other income, then return is actually required. Hope you remember in the morning session, we have solved a question whether the assessee is required to file return. I've told you that we will cover this in 115A. Say you are a person and you are only having incomes under 115A, either dividend or interest or royalty or FTS. Whoever pays you that income have correctly deducted the TDS. In such a case, don't need to worry about filing return. You don't have to file any returns. You are absolved from the liability of filing return. But if you have any other income, you need to mandatorily file return, whether or not the other income is subjected to TDS. If you have any other income and the other income is also subjected to TDS, it doesn't matter. Have other income, file return. Bus. Are you all here? Moving on to the last point, what are they saying? Set off and carry forward of loss allowed, permissible. From the above income, set off and carry forward of losses is permitted. But unabsorbed depreciation cannot be set off against above income. Why? Because unabsorbed depreciation comes in between 28 to 44C. Normal set off and carry forward is under 71 and 70. That 70 series that you can do. Except for unabsorbed depreciation, you can adjust other losses. That's what they are saying. You have some other business and you are incurring a loss. That business loss, you can adjust it from income under PGPP if it is coming under PGPP. Are you with me? So these are the conditions for section 115A. I hope this much is clear for you. Are you all listening? Have you understood what I said? Superb. So these are the deductions or conditions for claiming or while computing income under 115A. I hope all the conditions are clear for you. So friends, we have actually questions to solve, but this is the theory part of 115A. I hope this much is clear for you.